And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out.
Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I get nuts.
With your host, Phil Grande.
Bye. Thank you for joining me on my podcast. Hi, I'm Phil Grande, philsgang.com. So, what happened yesterday when everybody jumped into the stocks, the tech stocks? Why were they all excited? And they got out of the bank stocks. We're going to talk about that. And we're going to talk about why volume is so low. That's one of the biggest problems, is volume. And nobody ever thinks about volume, but volume is the fuel. Volume is the gasoline. It's the energy, the oxygen. And our volume is horrible. And when volume is horrible, all of these rallies, they're not real because they're not sustainable. Let me explain. So if you take, for example, the average S&P volume per day should be 65 million. We've been averaging 45 million. The New York Stock Exchange volume should be 6 billion a day. The run rate today is about 4 billion, 4.3 billion. That is a terrible, terrible thing. I mean, you've got to have the energy. You've got to have the good volume. Let me look. I just wanted to show you. Give me 1 second here. Let me go up to the tech stocks. 1 minute here. I'll find them for us. So the popular stocks, the only group that is really doing well, okay, in the tech group, is no longer our you know big mega stocks, the Magnificent Seven. It's the cloud stocks. And even yesterday, when money came out of the institutions, shifted their money from Bank of America, J.P. Morgan, where they've been hiding that money for months after month after month, plugging in there. They finally took it out, and they put the money into the cloud sector. So that means when you look at the volume, the run rate is terrible. 4.3 billion, that's it for New York Stock Exchange. 45 million run rate for spiders. That means that rally is not sustainable. It's telling you that move, when they pulled their money out and shifted to cloud stocks, is not sustainable. So what will happen every morning, the jibber jabbers get on TV and tell you buy this cloud stock and that cloud stock, but you're going to get trapped. It's a big trap. When there is no volume, when you don't have average volume, you're getting caught in a trap. Now, it's okay to get caught in a trap if you know how to short. But if you don't know how to short, you're too scared to short, you're going to get screwed. So that is not a good thing. Now, everybody was all celebrating that move, and it's just silly. There's nothing to celebrate. It's a bad move. And the other thing is, all we're doing is taking the same money and moving it around. That doesn't help. I mean, if you have the same 1.3 trillion a day trading, and we never add to that, we just shift it from one sector to another sector to another sector, it's not real. Now, if we have the volume, the average day, we have the correct volume each day, then every move would be real. But traders don't understand that, so they're jumping in these cloud stocks thinking, wow. Well, don't think wow, because it's just not going. You always have one or two stocks. I mean, CRM is one of our. We've been in CRM ever since the sweet spot, but you got to think about the volume. Is so important. It's the fuel. It's the gasoline, but it's not. We just don't have that, and so. The other thing, the 10-year and the 2-year yields, they're both going up today, and which normally helps, okay? Because 10-year and 2-year, when they rise together, that's good for your banks, it's good for your industrials, good for materials, energy, transports, small mid-cap stocks, discretionary stocks. But the problem is, we don't have the volume behind it. It's too low. So what's happening is the banks are weak, not strong. Okay, and I hope they stay weak because we want to put a short position on these bank stocks, especially the small bank stocks. Okay, if you look at the small bank stocks, KRE, the small bank stocks in that group there, they're really getting hurt. So not having good volume creates a lot of problems. And today, there's just no power behind that move that occurred yesterday. There's no follow through. The institutions didn't follow through, so it's just hard to hold that position. So when you see a day like yesterday, you get these big gap ups. Make sure if you're already in them that you sell into them. Take most of your profits, reset your stops, but 99.999% of people are getting in right at the peak. Right at the peak. We call them FOMOs, right? Fear of missing out. So the banks are weak. They shouldn't be. Oil's weak. Discretionary is the only one that is, they're talking about how strong discretionary stocks are, right? On TV all day. What are you, nuts? There's only one stock. Starbucks is green, and even that is an ugly stock. And if you look at Starbucks, so there's one stock that's looking good, and they're claiming that the whole discretionary group is hot today. But it's not hot today. One stock can't hold up the whole group. So when volume is lacking and these guys on TV start telling you this is hot, that's hot, it's all BS. Because when you have one or two stocks holding up the world, and you have right now, as we know, these all that money's coming out of these bank stocks. The big opportunity is everybody's wrong. They all think, well, I'm going to jump in and buy all of these cloud stocks. That's not the opportunity. The opportunity is when Bank of America breaks, the 200-day moving average or 50-day moving average, when that breaks, you're going to make more money shorting than you ever make buying, again, these cloud stocks. So the big problem nobody's talking about, they don't want to talk about, they don't want you to know about how bad it is when we have such light volume. There's no follow through. So again, so the cloud rally was nothing but a short covering rally. Be very careful with it because, again, the proof, no follow through buying. SPY volume is terrible. The run rate's 45 million, should be 65 million. New York stock volume, okay, run rate is 4.3 billion. It should be 6 billion. So right there is your proof that if you're chasing these cloud stocks, you're going to get hurt. You had to be in those cloud stocks in the beginning, okay? Now, as I said, the bottom line is discretionary is leading today, but it's weak. It's weak. So anytime you're in the market and the volume is that bad, it's just always remember what I tell you. Whatever moves you have, whatever gains you're making, they're not real. You're going to give them back. And this big move in cloud, if you bought these at the peak and you didn't buy CRM at the sweet spot where we bought it, you're going to give it back. It's going to, because today's proof there's no follow through. And the banks, again, they're not benefiting. So you got some real problems. The other big problem that nobody wants to talk about is the deficits. And I'm getting a kick out of that. There's just death silence on deficits. Do you know how much the deficits crush stocks in the market? And you sit there and you look at the S&P and you look at these indexes, and the only reason these indexes keep going up a little bit is because the guys on Wall Street, the big money managers, there's 6 of them, there's 12, but the big 6, they keep on buying indexes. We talked about this the other day. They keep buying the spiders, they keep buying the Qs to create an illusion that things are good. And that way there you won't take your money out of your 401k. So as long as they say every day, all-time new high, you won't take your money out of your 401k. You will not pay defense. In fact, what you'll do is keep putting more money in when you shouldn't. That's how they screw you. Remember the deal on Wall Street. There's only got to be one winner. There can't be 2. And they make sure it's designed so you lose, they win. And when they don't tell you the truth, and they keep buying these indexes, the spiders and the Qs, to mask what's going on, and everybody sees, oh, new high every day. Oh, I'm going to put more money in my 401k. You're going to get screwed because you're going to lose that money. Okay, so you've got to learn how to sell short. So, but the other thing that's interesting, and they don't want to talk about the deficits, and I'm so sick of hearing, okay, how great this economy is. It's the best economy over 238 years. Remember, the United States, 238 years old. And over the 238 years, there has never been an economy this solid, this great. What are you, nuts? What a bunch of BS that is, right? And especially when we have terrible deficits. Nobody wants to talk about deficits, and they should be talking about deficits. So if the economy is the best ever in 238 years, never had an economy like this, then why don't it feel like this is a strong economy ever? Instead, it feels like families feel like they're getting a financial enema. That's what it feels like. Anybody would tell you, I heard what everybody's saying. It's a great economy, and it's greatest in 238 years. We've never had an economy this good, but it still feels like a financial enema I'm getting. What the hell? You know? And so all this spending, where we're spending, you know, the deficit's $2 trillion a year, or we spent, just think about our deficit, since 2016, okay, we went from 600 billion to 2 trillion. That's 1.4 trillion increase in spending, more money than we take in. That's a 233% increase. Now they tell us we have the best economy ever in 238 years, so that money all must have came to us, right? That's why there's a deficit, because they must be giving all us that money. They must be giving all the families that money, right? Gotta be. No, they're not. Now, again, that money, okay, is because now what you got, instead, these deficits don't make things good for you. The deficit means you got a higher mortgage rate. You got a higher credit card rate. You got a higher car loan rate. Yeah, you're paying higher rent, higher food prices, higher insurance premiums, higher gas rate. I can go on all day long because there's a deficit. There's a deficit. So when we've increased our deficits by 233% over the last 10 years, what are you, nuts? And they're trying to sell us that this is the best economy in the world? And the best economy is 233 years? None of that money came to families, not our families. The money didn't go to our families. Now, if that money, if there was a deficit, and it increased 233%, and it increased by 1.4 trillion, and it went to us, to our families, okay. At least I'm benefiting. But we don't get that money. It didn't go to us. Know where that money went to? The government keeps spending. So the interest payments on the national debt keeps going up and up and up. They have to keep borrowing. And the worst thing is they're borrowing short term. This is why the market's going to crash. This is the silent killer of the market. But if I ever tell people, oh, the market's going to go, oh, yeah, the market will never crash. So think about, where did this money go? It didn't go to you and me, it didn't go to our family, but it went to interest payments on the national debt when it should have had those interest payments. They should have controlled it. They went to corporate subsidies. It went to government programs that they introduced, say, oh, it's only going to be for 1 year. No. Once they introduce it, it's there forever. It's there forever. Emergency spending. That's where the money went to. There's no such thing as emergency spending one time. It becomes permanent spending. And again, higher federal borrowing costs. So what he's doing now is the government's turning around and borrowing short term. So again, when you think of deficits, it's the silent killer of the stock market, because deficits kill the economy, because it's responsible for you having to pay higher mortgage rates, higher credit card rates, and everything else. So there's no benefit to you. So wouldn't it be nice if we knew that in 10 years we went from 600 billion up to 2 trillion, up to 233% increase? If that money came to us and helped our lifestyles, I'd go for that. But no, none of that money came to us. But yet they're selling us that we're in the best economy ever in 233 years, or whatever it is, 238 years, that we've never had an economy this good. Well, next time you go to the supermarket, food prices are still up. And the problem is that the danger here, this is why these wacko Bernie Sanders and the rest of these wacko commies, okay, are going to take over the Democratic Party. Because people are sick of it, and all they're hearing is free, free, free. Remember when Obama ran for president? What got him into office, Obama? Other than he was an excellent, excellent speaker. Because he promised what? Free cell phones. Don't have to pay a mortgage anymore. If you're poor, you get a cell phone. If you're poor, you don't have to pay a mortgage anymore. All these lies. That's how he got in, all right? And that's what they do. So when we keep hearing that we're doing fantastic and your car loan rates keep going up and your food prices going up and your mortgage rates keep going up and you can't even afford a house, the government spends more, but families pay more. This is what pisses me off. Excuse the language. Sorry about that. Should have said that. But this is what makes me angry. The government keeps spending more, 238% more. But families don't get paid more. What are you, nuts? This is crazy. So, again, the money doesn't go to our families. Now, the other thing is, during the 233% deficit increase, wages only went up 45%. And what held the wages down? Well, first of all, we got all these boomers retiring, 3 million of them, right? Labor shortages, okay, that's the big thing. Defensive wage increases, as we call them. Inflation, okay, keeps on rising. Productivity doesn't rise. And anyways, when productivity does rise, the worker, the labor, doesn't get to share. 75 to 80% of productivity gains go to the CEOs, go to the board of directors, the big shareholders. So the labor market, the workers, they don't get any of that 75, 80%, but they're telling us we got the best economy ever. And what's so dangerous about this is when corporations keep on taking 75, 80% of the productivity gains and put it in their pocket, and they don't share back with the workers, this is where you get Marxism. This is where you get communism. This is where you get these morons that are running around. I've never seen so many brain-dead people on TV in the last couple of months. Of these people who call themselves socialists. They don't even know what socialism is. They don't even know what communism is. So this all has to do with the stock market. And where can you point to that has something to do with stock market? Volume. That's what started this whole show today. It always comes back to volume. We don't have enough money participating. And the big money that needs to participate is the institutional money. And they're not participating. All they're doing is, like yesterday, move money from the banks, to J.P. Morgan and Bank of America, and move it to our stocks that, let me give you the best ones that we have, the ones that we're in. Okay, all these cloud stocks. CRM is one of our biggest winners, CRM. And that had a big move yesterday. And what was interesting, if you understand trading, if you look at CRM and you put it on a chart and you see the stochastics had a beautiful, beautiful trend. That means money is going in like crazy. And I'm going, why are they shorting? Just because yields are going to go up? Somebody's got it awfully wrong. And I told my members, look, don't change a thing. As a matter of fact, you can go listen to my coffee talk. I said, don't change a thing. Leave it. Let's see over the next couple of weeks, okay, what's going to happen. Because everybody was shorting it, and it didn't make any sense to me. Because the only thing you can rely on when it's all done, said and done, when you're trading, is what's going on with your stochastics. Because stochastics always is the truth teller. Yields is the truth teller. The stochastics always identify if money is going into the stock you own or if money's coming out of the stock you own. And no matter what they say about the stock, no matter how much they BS it and lie about it, the stochastic tells you the truth. If the volume bars are green and your stochastic's going up in a nice trend, money's going in. I don't care what they say. Or if the stochastic's going down, reflecting the bars that are red is telling you money's coming out. So they can say all day long, this stock is fantastic, buy, 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 buy. And you can tell by the stochastics, they're full of crap. They're lying to you. Money's coming out, so don't buy. So that's about it. Most people don't understand how bad this volume is and how it's going to take the stock market down. Because what keeps the market alive is volume. What volume? Institutional money. You've got to have the institution money. I mean, they control, remember, in the stock market, $13 trillion. 13 trillion. All we're trading in there today is 1.3 trillion a day. Because they've taken their money out and put it in the sidelines. You can't have a sustainable market like that. The market's going to correct. It's going to crash. But everybody's so spoiled right now. They say, oh, the market will never crash again because of AI. No, it's going to crash because of AI. But again, the big institutions are smart. They control the money. They understand what's underneath this market. And that's why the volume's terrible, because they're not buying. And if they're not buying, why are you buying? Learn how to sell short. Okay, and when you do buy something, make sure you're buying the best. Make sure you got relative strength, good volume behind it. We'll show you how to do that. We've been teaching people since 1998. We can still help you too. That's about it. So I hope you enjoyed that little information, especially on volume. We're in a very dangerous period. Oh, no, we're not. The market's just going to keep going up and up. It'll never come down. Because every day they hear the same thing, all-time new high. But they don't understand the scam behind that all-time new high. They keep on pushing up the indexes. And as long as the institutions in Wall Street keep pushing up the same indexes, the S&P and the Qs every day, it makes the market look great when underneath it is a big cavity, this quicksand. But every day, new high, new high, new high, and they just keep masking it over and over and over every day what's going on in that market. So that's why don't get caught up. Don't start chasing these cloud stocks. You should have bought them when you had a sweet spot. That's when you should have bought them. So I'll bring home some milk, I guess. All right, I'll see you on the charts, okay? So have a great weekend. See you back here on Monday, and I hope you enjoy me on my next podcast.
Are you nuts?